Welcome to The Explainer. Today, we're driving into a really powerful strategy for building wealth, even if you feel like you're starting with just pocket change. We're going to see how these tiny, regular actions can, believe it or not, lead to some massive results over time. But let's start with the big goal here, right? Financial freedom. And look, it's probably not what you're thinking. This isn't about having a private jet or a mansion. It's really about having the power of choice. It's that ability to say no to a job you hate or yes to taking a break when you're burned out, all without stressing about the bills. It's about being in control of your own life.
For most of us, though, that kind of control feels, a million miles away. We're often caught in what you could call the small savers dilemma.
And this is the question that I think stops so many people before they even start. You look at your budget, you find a little bit of wiggle room, maybe it's 10 bucks, maybe 20 a week, and you just think, seriously, what's the point? What is this tiny amount possibly going to do in the grand scheme of things? And you know what? It's a totally fair question, because if you only look at saving, the math is, well, it's pretty depressing. You save that $10 every single week for a full year, you've got 520 bucks. I mean, that doesn't even get you halfway to a new phone. It really feels like you're just spinning your wheels. So, if saving by itself isn't the magic bullet, what about investing? Well, that's the other side of the dilemma, isn't it? The thought of taking a big pile of your money you worked hard for, and just throwing it into the stock market, it's terrifying. What if you invest it all right before a huge crash?
And see, that's the trap. It feels like you either do nothing or you risk everything. But what if there was another way? A way to get the upside of investing, but without that gut-wrenching terror of a market crash. What if you could actually turn that fear into your biggest advantage? Well, you can. And it's an incredibly simple, powerful strategy.
It's called dollar cost averaging, or, DCA for short. Now, I know the name sounds a little technical, but the idea itself is about as simple as it gets. You're just buying a little bit of something over and over again on a set schedule. That's it.
Okay, let's break this down. It really is just 3 easy steps. First, you pick an amount you're totally comfortable with, like that $10. Second, you choose a schedule, like every single Friday. And honestly, this is the most important part, the part where people trip up. You just stick with it. You set it and forget it. You let the system do its thing, and you ignore all the crazy headlines.
And this is the magic trick. This strategy completely flips your whole mindset. See, for somebody who invested a giant lump sum of money, a market dip is just pure panic. But for you, the DCA investor, a dip is an opportunity. It's a sale. Your $10 is now buying more of that asset than it did last week. You're getting it at a discount. Suddenly, volatility isn't scary. It's your best friend.
Okay, that all sounds great in theory, but does it actually work? I mean, where's the proof? Can that small, consistent investment really add up to anything meaningful? Well, let's take a look at a few real-world examples using actual historical data.
First up, let's take a company we all know, a pretty stable tech giant, Apple. Imagine 5 years ago, you decided, okay, I'm doing it, 10 bucks every single week goes into Apple stock, no matter what.
So what happens? The result of that one simple automated decision is pretty staggering. Over those 5 years, your total out-of-pocket investment is $2,600. But because you were buying consistently through all the little ups and downs of the market, that investment would have grown to over $7,000. You would have nearly tripled your money just by showing up every week.
All right, so what happens if we apply this same exact strategy to a stock that's known for being a bit more of a roller coaster? Let's look at Tesla over that exact same 5-year period. Again, just $10 a week.
And wow, this is where you really see the power of buying when things are volatile. The total amount you put in is exactly the same, $2,600. But because Tesla's price had these much bigger swings, your consistent $10 buys were able to scoop up shares on the cheap during those dips. The final value? It would have soared past $31,000. I mean, think about that. That's more than a 10-fold return on your money. Okay, for our last 5-year example, let's go to the extreme. Let's look at one of the most famously volatile assets on the planet, Bitcoin. Same rules as before, 10 bucks every week, don't even think about it. And with Bitcoin, we see this whole principle just get supercharged. A total investment of about $2,600 during a period of just insane price swings would have grown to over $32,000. It shows how consistency can turn what looks like chaos into absolutely incredible growth. Now, those 5-year examples are pretty mind-blowing, right? But the true magic of this strategy really gets unlocked when you add even more time to the equation. So, to really drive this point home, what if you had started that same $10 a week plan, but 9 years ago with Bitcoin? Okay, you might want to sit down for this one. A total investment of just $4,700 spread out over 9 years could have turned into nearly $1 million. Just let that sink in for a second. This is the absolutely explosive potential when you combine consistency, a long time horizon, and a high growth asset. It's just incredible. So, the big takeaway here isn't that you need to be some kind of genius stock picker or a market timing wizard. None of these amazing results came from that. They all came from a dead simple system that's really about mastering your own psychology.
And these are the secret ingredients. It's consistency, which you make easy by just automating it. That stops you from forgetting or making excuses. It's patience. You gotta think in years and decades, not days and weeks. It's having belief in what you're buying, so you don't sell in a panic when things get choppy. And finally, the hardest one of all, emotional discipline. It's having the strength to set this whole thing up and then just get out of your own way. Let the system do the work for you.
So, we'll end with this thought, of course, and this is important. These past results are absolutely no guarantee of what will happen in the future. But the principle behind it all, that small, consistent efforts, compounded over a long time, can lead to life-changing results. That idea is timeless. So the real question isn't what could have been. The real question is, what are you going to start building today?